You're listening to Accounted For, the Canadian podcast that explores the intangibles of every career. I'm your host, Daniel Lee. Hey everyone, welcome back to Accounted For. Is it a little loud? For context, I am at the Vancouver airport, and I am at a lounge, but it's one of those open air lounges next to the bag and security check, so that's why it's pretty loud. So forgive the noise for me. But yeah, welcome back to Accounted For. Happy Wednesday, and today is another blast from the past, and it'll probably be the final one until probably the next quarter, as I'm in week 2 of my quarterly retreat, and as I told you, I'm at the airport, getting ready to go back to Toronto and get my mind reset for the new quarter to come, the next 3 months. So I thought, why not share another very popular episode from the past? And so, without further ado, I hope you enjoy this episode if you've never heard it before. And if you have, then maybe this can rejig some inspiration for you for the upcoming week or month or whatever. So, yeah, hope you enjoy. And I hope to come back to you with more fun, interesting interviews that will expand your perspectives, help you question the default path, as well as inspire you to action for your career. Hey folks, happy Wednesday. My guest for today is Sam Restagno. He is one of the managing partners and co-founders of Golden Spruce Capital. And this was a really fun conversation. Golden Spruce Capital is a private investment company that focuses on buying small businesses. And we kind of classify this as companies that have an EBITDA of $1 to $5 million. And for some of you who are not in the accounting realm, I don't want to make you feel as if you're left out. And EBITDA stands for earnings before interest, tax, depreciation, and amortization. Yeah, I'm not really going to go into the history of why that was made, but it's a very relevant term in the world of investing and just overall finance. But yeah, so our chat with Sam takes me through just how he persevered through his career journey. He was really dead set on going into investment banking when he was in university, and the first time around just didn't happen, but he eventually makes it through. And we go through the process of really making the decision to leave that plush expense account and the comfy life that banking ultimately rewards the people that get in there with, and really taking the journey to start a 2-person fund with his business partner. And we really dive into the world of small company investing and like the really big importance of relationship building in that aspect, the opportunity size of that in Toronto and just general Canada area, as well as just the various funding options, like how do you run $5-20 million fund, and the realities of how frugal you have to be, how much you really have to hustle, even if you are running a private equity fund, because when you start off, it's just going to be like any other startup. I personally got a lot of value out of this chat, and even if you aren't someone who isn't really hell-bent on running your own investment company in the future, I really think you'll be able to extract a lot of value out of our conversation as well. So I really hope you enjoy my chat with Sam Restagno. Hey everyone, thanks for joining us now on Accounted For once again. Today on the podcast I have Sam Restagno. Did I pronounce that right?
You did. I'm very surprised.
Thank you.
You did your homework.
Yeah, I did. Sam is the managing partner at Golden Spruce Capital. And so, Sam, can you just, for our audience's sake, give a quick explanation of what Golden Spruce Capital is, just for their understanding?
Yeah, sure thing. So Golden Spruce Capital is an independent sponsor, and I'm sure we'll get into explaining what that is, but an independent sponsor that looks to make investments in what we like to determine or classify as best-in-class businesses, small, medium-sized businesses. So businesses spanning $1 million to $5 million of EBITDA. We focus primarily on Ontario and California-based businesses, although we are looking at some opportunities broadly across Canada, but are fairly concentrated in those for selfish reasons. And then we like a myriad of industries that I'm sure we'll get into. Really like tech-enabled businesses, like asset-light businesses. And really businesses where we can generate a partnership with existing owners and managers. The genesis of Golden Spruce Capital was providing a means to aid in succession planning, because we noticed a real dislocation in the market where there's a lot of really great mature small businesses that have been run like family businesses for a long time. That the first generation created it, the second generation doesn't really have an interest in working in a widget based business. They in a lot of cases want to be artists, or want to do things that being the second generation of a high earning business is the byproduct of, and we tried to insert ourselves there to assist that transition planning, that succession planning. Funny thing there is it was initially intended to target, call it the 50 to 60 year old entrepreneur that was looking for that, okay, I need to retire and I haven't really been able to think about it. And oddly enough, we've had our greatest success with the younger entrepreneurs that are looking for partners, and not necessarily succession planning, but more so in just helping professionalize and add some jet fuel to the business. So long-winded way to say independent sponsor that focuses on small to medium-sized businesses.
Okay, no, I think that was definitely a good color to have though in the industry, just because my understanding is like I have friends in private equity. Also, I grew up in Vancouver, and so in Vancouver there really isn't much of an industry except for small business owners. And I think I'm at that generation with my friends where we have parents who are part of the baby boomer generation, and they are either going to give you the business or preparing you to take over, which is happening with some of my friends, or my friends try it out and then they say, I don't want to do leather goods and shipping of bags anymore. Like, it's just not my thing. And so then the parents decide, okay, we're going to sell off. And that has been a very common, I think, thesis that's been brewing up with, like the baby boomer wave. They're all going to seek liquidity. They're not going to get as much yield on their retirement funds anymore. So they want to sell their business. And so I think a lot of people thought that would be the big play for the lower market private equity side. And from what you're telling me, that's actually quite surprising that you've seen more success with the younger people. Well,
it's not. I think that might be more a function of the sample size isn't huge, right? Like we've been at this for 2 years now. My partner Laith Asher and myself have been at this for 2 years, and have spoken to upwards of 200 to 300 entrepreneurs and also businesses by definition. And I'd say the majority of those are folks who are that north of 50, and say whether the child doesn't have interest or the parent doesn't believe that the child is capable. We see that a fair amount. Where we've had success is, we've just developed good relationships with a few folks that happen to be a little younger, but we've got great relationships with some older folks that are kind of in that more traditional, looking to provide that layer of succession transition planning in their own business. But yeah, certainly not by design, and that's one of the things I'm sure you've talked to, some startup founders. You've got to be able to pivot. And you've got to find your spot that's working, and that becomes your business model that day, right? So we've stayed fairly flexible through the whole thing.
Mm-hmm. And before we go, I guess, deeper into the Golden Spruce model, which I'm just so fascinated to learn about, when I did a little digging in your background, it would, you look on LinkedIn, then we see you went to Western, and then you did some financial planning controller work, and then you went to Rotman to do your MBA, then some investment banking. And then you went to do some corp dev at Dental Corp, and then now you're launching Golden Spruce. So if you could take me back to kind of the earlier years, what was the transition like in terms of you graduated, and did you have it seemed that you always had an inkling to go into the finance world, and how did that kind of thought process and design work?
Yeah, I definitely did. I think it started a little younger. It started a little younger for me in terms of, that was my father's background. He was in finance, and I was always intrigued by it. And then as a very pliable teen and an influenceable teen, saw some movies. I was like, oh, this looks like a lot of fun, and I'd love to live in New York or Los Angeles and work in finance. It sounds fantastic. So I went to Western and knew I wanted to get into finance, and and I'm unfortunately the listener can't see me do the air quotes, but knew that I wanted to do investment banking, and that's really what my career was going to be. Because as every 18-year-old knows, they know exactly what they're going to do in their career. And I'm, we're just figuring it out now. But, figured out I wanted to do investment banking, and, the process to get into banking is you alluded, you've got some friends that kind of went that path. It's competitive. It's challenging, right? And if I'm being honest with myself, I probably had a little too much fun in undergrad, where getting into banking was tough. And I can't imagine the kids today graduating, or it's a bit different because we've had quite a run for some time in terms of the market, but this was 2007, 2008, so they're hiring in droves, and I'm not one of them, right? So I kind of had to reassess and say, okay, well, I'm going to do it eventually. They're just not going to let me in the front door. I'm going to come in another way. And ended up getting a great gig with Siemens, the European engineering conglomerate, in their oil and gas, on their oil and gas team as part of this development program. And I remember I was so eager to get the job. In the interview process, they said, would you be willing to move? And I made a comment saying, I'd move to Kalamazoo, for the gig, just as a joke. I didn't even know where Kalamazoo was at the time. And sure enough, I get a call, a week later saying, good news, you're one of 6 people that we're bringing into this program, and it was very competitive to get in. And good news, you're bringing in this program. I said, that's fantastic. And I said, when do I start? I said, middle of May. Great. So you're, we'll book your flights for you. And, sorry, what was that? She's like, oh, you're starting in Calgary. And I said, oh, wow, okay. I guess I did agree to that in the interview, didn't I? I didn't think that my words mattered. So I ended up going out to Calgary and doing some operational finance. I really enjoyed it. I was on the oil and gas team there, managing a few different pipeline projects, and just so happened that, it's one of these things that happens in your career. These weird opportunities kind of pop up. And as I was starting, the director who I was supposed to be reporting to, who directed the project, ended up going on mat leave early because I think she had her child a little premature, and I stepped into the role. They didn't give me the director title, but I took on a lot of responsibility, and kind of flew by the seat of my pants and figured it out. And at the end of that, I was there for about a year, and then moved back to Toronto and joined the healthcare team, which was a lot more. I'd like to compare it to almost an assembly line, right? You've got a product, someone buys it, and you just kind of fulfill. And there was more, FX hedging and things of that nature, but it wasn't that exciting. And I knew, okay, it's time to get back to what I wanted to do, which was banking. And so I actually sent emails to about, call it 70 to 75 investment banks saying, hey, I want to work for free. I'll come and work for free for you guys. And, knew that the big guys wouldn't be into it. So I looked at all the boutiques of small guys, and, there was actually, I only got feedback from one, and this is to work for free. So now this is, call it September 2009, and no, a little later, maybe January 2010, and got an email from one saying, yeah, we'd love for you to come on. I won't name them because I don't want to, get you into any trouble, but said, yeah, we'd love for you to come on. I said, great, I'd like to put some term on this. How's 3 months? I said, no, we want you to work, indefinitely. I'm like, okay, well, last I checked, servitude's illegal in Canada, but, slavery's not allowed. And, so I ultimately said, you know what, forget it. I went to get my MBA at Robin and said, this is the way I'm going to get in. And, sure enough, 3 months later, I was in as a summer associate and had a few different options. And the funny thing is I was the same guy I was 3 months earlier, right? I had 3 months of an MBA behind me. I effectively, the first year of an MBA is quite repetitive if you've done a commerce undergrad or a business undergrad. So I did the same schooling, was the same person, and yet now getting in as an associate with the big banks was really easy to do because of the signal of the MBA. And I'm certainly not complaining. It worked out well. And then I made my transition, to the other gigs. I was at RBC for some time on with the sponsors team, which meant I covered private equity, pension funds, sovereign wealth funds. So you had the benefit of doing a lot of client stuff. I had a great team there. Really enjoyed the transaction work, but really, really loved the work that my clients were doing, covering the private equity space and even the sovereign wealth fund guys to a certain extent. And, I got to dabble in both. I got to do the, high volume of investment banking with, diving in fairly deep and on really interesting assets with the private equity guys. So it was there that, actually that's where Laith and I, again, being my partner, decided, hey, this would be pretty cool. This is kind of the search fund era now. We're in 2011, where, Oxo Capital and a couple other guys started up. And we looked at that and said, that looks like fun. We should do something like that. And it just so happened I was in the sponsor space. So kind of long story, that was the initial seed of, hey, this is pretty interesting. I could see myself doing this long term. As a funny aside, it was my first day of my MBA. And my whole life I wanted to do investment banking. Not my whole life, my whole adult life I wanted to do investment banking. And Toronto Life came in and asked if I would do a little bio on myself that they could feature in Toronto Life. And I said, sure. And they said, what are you going to be doing in 10 years? And the natural thing for me to say was investment banking, because that's what I always thought I would be doing. But instead, I said I would be a managing partner at a private equity fund, which, if I'm being honest with myself now, I'm not quite sure that I knew really what that meant at the time. But it's just funny that it kind of worked out that way. So it's been a roundabout way, but, really happy with the choices and where I landed.
Yeah, no, I think that little foreshadowing is really, really something there. It's kind of it's a little Freudian-esque where you do a little bit of psychoanalysis and you deep down you knew what you wanted, even though it wasn't really. Yeah,
it's almost
really
like it wasn't my choice.
Yeah, it's like you were destined to be in that realm.
Right. It probably builds it up to a lot more than it probably. I might have heard it for the first time that day, and I thought it sounded exciting, and I had a vague idea of what private equity was. But it's funny how it came full circle.
I think even the timeline of everything is also, I think, quite unique in that you were looking to get into the finance world. But I guess the great financial crisis had happened, and I think so that is really timely, because I think that was so I'm a few years younger than you, but my kind of year of people, we saw that when we were pre-university, and then everyone became like the big accounting cohort, and everyone was like, we want stable jobs, and became really conservative. And so you see this huge entrance of accounting people and not so much people who want to do investment banking.
Right.
But you kind of held on to it and just continued to push through despite that.
Yeah, it might be for a lack of awareness. Who knows, right? I mean, I might not have been reading the headlines the same way everyone else was. But no, I mean, the jobs were still there. It was still a necessary part of the market, or part of the economy. And it wasn't popular at the time, right? I think a lot of that industry had been vilified, and some of it justifiably so, as a result of 2007, 2008. But yeah, just stuck with my guns. I knew I wanted that. I knew I had the horsepower, right? I think a lot of people get into investment banking thinking they know what it is, and then until they get there, they don't really know what it is. And that was certainly, I can't speak for other people, I'll speak for myself. That was the case with me, where I had this, really shiny idea of, what investment banking was and what the life of an associate was. And it was probably informed by a lot of media and, in my teens. And I got there, and not that I didn't like it, I really enjoyed it, but it was very different. And maybe the environment in Canada, and certainly actually I know this, a few of my friends are in the States doing this, but the environment in Canada is very different. It's much more buttoned down. It's much more conservative. There's no that quote unquote models and bottles, and I think the industry is better off for it as a result. And but yeah, it was quite different from what I expected. Even the work product was very different, but I learned a ton and really enjoyed it.
Yeah, I think in terms of just the path you took, where I was actually shocked that you only got one reply back after 70 cold calls. because
maybe I didn't know how to write an email yet. I mean, it's quite possible, but yeah, I mean, it was daunting. I thought for sure, okay, I'm willing to give up a good job at Siemens and to do this for free in what I believe to be a lucrative industry, which is a lucrative industry. And I can't even get an email back, right?
Yeah.
To say, hey, I'll work for free. So it was pretty daunting, but call it hubris. I just stuck with it and managed to kind of break my way in.
Yeah, no, I think perseverance is actually a big factor of people achieving what they want. Like, because when I was first getting my shot at the buy side, I think I cold emailed 60 to 70 buy side managers myself too. Mm-hmm. And maybe it's an industry thing, I don't know, but I had a hit rate of around 30%.
Oh,
so,
wow.
Yeah, I spoke to about 20 to 30 buy-side managers in Toronto.
I got to get you to start writing the emails when we reach out to new entrepreneurs.
maybe.
That's higher than our hit rate, for sure.
But yeah, but I think though, like that kind of, it teaches you something, right? It teaches you grit. It teaches you how to just constantly keep at something.
Right.
And I think even in like the MBA path, like coming from my kind of consulting background, a lot of my friends all think about MBAs. Like every consultant thinks about doing an MBA because it's just so normal. And I think when people ask me like, oh, should I do an MBA, Dan? I was like, that's why do you want to do it? And like reasons like what you did, where it's very focused. Like I want to do investment banking, and here the facts show that 30% of MBA grads go to investment banking,
right.
30% go to consulting. And it's very focused compared to some people who just go and say, I don't know, I just want kind of God to hit me with lightning and tell me like, you are destined to do this, and then just kind of go with it.
Right, which is not how I think. I do a lot of chats with undergrads and post undergrads that are call it the analyst level at investment banks or even at the accounting firms, consultancies, etc. Say should I get an MBA? I'm thinking about getting an MBA, and I'll ask the same. Well, why? Right? What is it? What is it you're looking to get? And and I'll liken to my experience. What I needed this signal to the market to say, hey. Don't look at the kid I was in terms of my grades, but look at the person I've become, and I can get into an MBA program. I can score well on the GMAT, et cetera, et cetera. My grades are good, blah blah blah, and I can present okay. But I knew I couldn't get the audience to present to without that, right? So it was. I was young when I did it, and it was. I shouldn't say it was an expensive risk, but. It was certainly a capital. I was allocating a lot of capital. I was giving up income, and I was spending a lot of income, and we're spending a lot of dough. So I think that certainly played into it for me. But overall, I think you end up getting the MBA because it provides that window. But what it also does, and I think that I'm seeing more of that now, and I'm certainly appreciating more of that now. My network is my MBA, classmates, right? And U of T is a bit different because people tend to stay in Toronto. It doesn't have that kind of global dispersion that call it a Harvard will have, where you have people from all over the world going to Harvard and then they go back, right? So they'll go to New York, they'll go to LA, they'll go to Toronto, they'll go to Vancouver, they'll go to Hong Kong. You kind of have that global network. With U of T, you have a far more localized network, but it's played out well. I still do a lot of work with my classmates, and I certainly approach them with problems and things of that nature. Some of them are my investors actually, so it's worked out well. But I think you have to have a targeted approach to why you want to do it, because to do it just to do it doesn't make a ton of sense, and it's probably a poor allocation of capital. But at the same time, you're improving yourself, and if you've got if you can justify it, then why not?
Mm-hmm. Yeah, no, I totally agree. And so you're at RBC in the financial sponsors team, and so to kind of clarify my limited knowledge, so that team, your clients are purely like private equity firms or like buy side clients, and
yes,
you're helping them. Is it just raise more capital to go about with their acquisitions?
Yeah, so it's primarily, we're on the debt side of the equation for the most part there, right? So we'll do a lot of, I still speak like I'm there, but we would do a lot of debt raises for them and work on that. At RBC, we were one of the few banks, actually at the time, the only bank that could really had access to the U.S. institutional debt market, because, we had a large presence in the capital markets in the U.S., but did a lot of that, and then did some sell side work as well for portfolio companies that were spinning out of a fund. worked on, looked at some IPO stuff as well for exits. But I mean, they're not really hiring you for buy side advice because that's what they get paid for. Got to touch a myriad of aspects of the transaction, which was really interesting.
Mm-hmm. And I think that I call banking, consulting, audit kind of more platform jobs. Like there are things that you go in when you're young to do for a couple of years and hopefully to do something else. Most people don't go into those to like stay there for long term. And I think it's good to see who your clients are, because then it kind of leads to a higher possibility or probability that you'll end up in that space, because generally your clients will kind of take you because it's a people hiring people business, and people want to take people that they know. Like when I was an auditor, I was like, I don't really want to be on the client side. I don't want to be a controller.
Right.
And you go to consulting, you see, okay, do I want to be on the strategy side, and vice versa, I think. And so I can definitely understand how for you, the private equity side was just very purely obvious in that perspective.
Right.
But after that, you went to Dental Corp instead of starting Golden Spruce right off the gate.
Yeah.
What was the rationale behind that?
Yeah, I think part of it for me was, right place, right time. I had worked on the debt raise for Dental Corp when Imperial Capital and OP Trust made the investment in the business. I worked on the acquisition financing, so got to know the management team there, built a good relationship with them. And they had approached me to lead their partnership development side, so their business development. So effectively, I was flying around the country speaking to dentists, right, and trying to buy their practice. But I worked hand in hand with the corp dev guys where, they were doing the execution and I was doing the deal sourcing and the relationship building, etc. A lot of miles, in my last 6 months, actually, not even, 6 months, I flew 75,000 miles exclusively in Canada, and I didn't have many flights to Vancouver. So there was a lot, I would do 3 or 4 flight segments a week. And it got to a point where, I wasn't getting younger, and wanted to make the transition out. But the reason I ultimately decided to go to Dental Corp before starting Golden Spruce Capital, not that I had a crystal ball, but I was young at the time. I think it was when I left for Dental Corp, that would have been in 2015. So, pre-30, and I knew that I didn't quite have the small business experience that I needed to really be able to hold hand to heart and look an entrepreneur in the eye and say, hey, I've been part of this before. So I wanted to get that smaller business experience, and Dental Corp was a company that was growing hand over fist very, very quickly. When I started, I think there were, I want to say around 30 people in head office, and when I left a year later, there were 75. So seeing that growth and seeing the infrastructure kind of grow at the same time ended up being very, very valuable for me, because it's something I can relate to, the owner operators I'm chatting with, just because most of the business we speak to are growing pretty well, not 100% a year, but call it 25 to 30% a year. And understanding that challenge, I've been part of it. And I knew that would be important. Not to mention, there's certain perks of working for a very big firm that you don't have going to a smaller company, which is something I needed to get used to. I didn't have an assistant, right? I didn't have, an analyst running and making photocopies. I didn't have a desktop publishing team putting presentations together for me. I mean, you're kind of rolling up your sleeves and really doing it all yourself. And that was a nice way to kind of, dip the toe in the water and say, okay, let's get used to this first. Not that I require that kind of coddling, but you get used to it, right? And the expense account, etc. And I knew that ultimately I would have to get away from that if I wanted to go in the small business realm. And I think it paid off, and it got to a point where, I was flying around the country and convincing, dentists and, they're business owners and operators as well. And I was flying around and I was convincing them to, do a deal with us. And here's all the reasons why. And, Laith and I had stayed in contact and had become, stayed friends over the years. And I'd always kind of touch base every quarter or so to say, hey, are you ready? Are you ready? Are you ready? And it got to a point where I said, there was some life circumstance stuff where I said, hey, I think now is a good time. I think, I'm beaten up enough now that I can go out in the market. I've got just enough gray hair to I think be taken a little more seriously. And, it's something nice about being 30 because you can say you're in your 30s, which I know sounds ridiculous. But, when you're talking to business owners that are in their 50s and 60s, oftentimes we'll get asked the question, how old are you? And you could say, I'm in my 30s, right? It sounds silly, but it makes a difference because their kids are in their 20s. And you might only be 18 months apart, but in your 20s versus in your 30s sounds very different. So I found that was quite helpful. So it felt like it was the right time. We had support from who are now our anchor investors and families. We had their support. We've been told a couple times, hey, if you guys ever look to do this, we'd love to deploy some capital behind you, which we said, great. We said now's the right time, and Laith's background is excellent. It's operational. He was at McKinsey for a number of years after investment banking, so he brings a lot of the strategy and the operational piece to the forefront, and I brought more of kind of the deal and the finance piece, and slowly it's kind of melded into one, and it's been a very cohesive partnership. So it just worked out well, right place, right time, and it was an aggressive leap though. I mean, it's tough to cut off all income sources and say, hey, I'm going to go ahead and bet on myself. And that's where we're a bit different from a search fund because we were self-financed. So we actually put our own capital up to say, we're going to go out and find deals and we're going to take the risk on them. And we're going to be the ones, spending money on the accountants, spending money on the lawyers. That's us. It's not our investors if the deal doesn't go through. And, we had one of those where the deal didn't go through and it was our necks out there, right? And it was our wallets that were funding it. So it was a big leap, but hey, it panned out, or else we wouldn't be chatting.
Yeah, no, that's definitely like a great story. That I definitely am going to dig further into. But no, I think that the saying you're in your 30s is actually a very big deal. Obviously, like our generation, like especially like the millennials coming up, they might get upset hearing them saying, "Oh, that's so ageist," and how can you judge people like that? But yeah, like when I was in consulting, I heard about partners purposely graying their hair just to be respected, and
right.
Like as someone that looks like he's 16, I think it's definitely.
Don't count yourself. You look at least 18.
All right, thanks,
at least
man.
18.
Thank you. I appreciate that. But yeah, I think that does kind of play a part, especially in the people business, where you're trying to make connections with other people and trying to convince them of your competence.
Right, and I think it's certainly, it's primarily the first meeting. I'll never forget one of the first in-person meetings we had when we had Golden Spruce Capital. I had driven out to West Toronto and met a fellow who owned a factory of sorts. He manufactured things, and I came to the front. I said, hi, it's Sam here to see, we'll call him John for the purpose of this conversation. It's Sam here to see John. I said, great. And we had been back and forth by email saying, okay, John, we're going to, meet this day and looking forward to meeting you, blah, blah, blah. We had a couple phone calls. And so John gets to the front. He says, oh, hi, nice to meet you. I said, yeah, you as well. He said, is your boss Sam going to be coming? And I said, yeah, he is. He said, oh, great. He said, soon? I said, no, he's here. I'm Sam. It was a bit of a laugh, and those things are common, but it was quickly thereafter. Like if you need to be over 30 after that point to be heard in the room, you're probably not communicating properly. It's always been the first point of interaction, and after the fact, you've got to be able to communicate your point, and whether you're 17 or 80, if you're ineffective, you're ineffective, right? So it really is that initial meeting, and then after that it wears off. It's a good thing that my partner has a lot more grays than I do, so it adds more credibility. For those who don't know, my partner's sitting about 20 feet away from me, and my feet up, and I'm probably gonna hear about that one after.
And you talked about how so Golden Spruce, in the beginnings you thought about the idea initially came out from, oh, the search fund model is interesting. And for the audience that are not familiar with a search fund, you can correct me if I'm wrong from my understanding as well, but the way I understand it, that generally is practically you raise a bunch of money from other investors, and with that money you have about a 2-year window to go out and buy a business, just all of it. Usually tends to be more of an older style business, like a big factory or something, and then once you buy it, you move your entire life to where that company is, whether it's like North Carolina or something,
Right.
and then you just operate it as the new CEO. So that's the traditional kind of search fund model from my understanding. Did I miss anything there?
Yeah, the only nuance is, so you'll typically raise what they refer to as search capital, which pays for your, you can pay yourself a nominal salary, and it pays for your travel expenses when you have to go out and meet, entrepreneurs and, take them out to dinner, et cetera, and pay for accounting fees on broken deal costs, et cetera. So that gets covered by the quote unquote search fund component or search capital. When you actually find a business, though, the difference is that capital hasn't been raised yet. So now what you have to do is you go back to your funders and say, hey, I found one. Do you want to participate? And they have the choice to say yes or no. If they say no, that doesn't stop you from doing the deal. They just have the first option. You can then go outside of them and raise the capital. But their search capital will get promoted into the deal. And, the market's changing, but, anyone listening to this can go to the Stanford Business School website, and they've got it's called the Search Fund Primer. That kind of explains the traditional model. But yeah, the traditional model is exactly that. And then, you find a business in Wisconsin, and you buy it and you fly down there, and you're now, traditionally, you're the CEO of the business, you're the president of the business, whatever, and you're running it. And now you're an operator, but you're no longer looking to actively acquire, because you're day to day in a business and running a business.
Mm-hmm. And generally, from what you've seen, how much does the search capital really cost to go out, find a business and all that?
Yeah, I think it depends how you travel, right? I think, and how you spend. We're pretty diligent on our expense side. I'd like to think that we'd be this way even if we had search capital. I'm actually certain we would be, but we spent time looking for an office lease, right? We didn't rush into it and say, we want the one on the 30th floor with windows and, overlooking, Lake Ontario. No, we're like, no, this one works well. We have 4 desks, which is great for us and interns. It's in a basement. Who cares, right? We're good. We can work from a basement. Does it have internet? Yes. Okay, great. So I think it really depends on your approach to things. As it relates to deal costs and things like accounting and legal, I think your expenses, where things start to get quote unquote expensive, is when you have broken deal costs. That's because if you get the deal done, a few $100,000 in legal and accounting fees, depending on the size of your deal, is fine. It's where you don't get the deal done that you still have to pay that amount. Then now you've kind of depleted it. But I think on average, most folks are raising, $400,000 to $500,000 for a 2-year fund. That's probably one partner though. If you have 2 partners, maybe $750,000 for the search capital piece. And if you happen to acquire in month 3 and you've only spent $200,000 of that, the $550,000 gets returned to investors in most models I've seen.
Mm-hmm. And for you, you and Latham, you guys decided, okay, no, we're gonna use our own capital, mm-hmm. and when you find something, then you are going to go back to your fund investors and say, okay, we're ready, we have something, and that's when you decide to raise a fund? Yeah,
well, it wasn't even raise a fund. So an independent sponsor will go and, find the deal, negotiate the deal, and then approach investors and say, hey, here are the deal terms, here's the business, right? It's almost back to our banking days, except we actually have to, think about the strategy. But here's the business, here's how we think we can help, here's where we think it can grow. Here's the famous and infamous model, right? Because we can predict 7 years into the future, but based on what we've understood, here's what the business is going to look like in 5 years, based on some of the things that low hanging fruit and the operational levers we believe we can pull, and here are the deal terms, and here's what you want to invest on, and minimum investment X, and if you want to, let us know. We'd love to allocate some room for you. If not, that's okay. We'll show you the next one. Where it was a bit different for us was, we funded the search component ourselves. And one of the reasons we did that, one, we were a little older than your typical search fund investor, although that's changing a little bit. I know some folks that are doing this, out west in Calgary that are, seasoned folks, and men and women. as well as in the States. But the traditional model really came out of Stanford that, okay, you graduate from your MBA after having done banking and then done your MBA, and now you're going to go out and buy a business. So it's a bit different now. So I think I know of more people that are going the self-financed route. I didn't know at the time when we did it that there were a lot of guys, actually, in speaking with our lawyer who's, the box on search funds in Canada, he said, not many guys are doing this. And, he was actually advising us to do the opposite. But the thesis worked out because one of the reasons we wanted to do that was we didn't want to pin ourselves to economic terms prior to getting the deal done, right? And, typically you agree on a certain economic term for yourselves as the searchers that says, okay, I will, I'll get 20%, 2 and 20 kind of traditional model, or
right.
The most common in search funds is kind of 10, 10, 10, 10 being on, 10 being on time, 10 being on performance, and 10 being on, it slipped my mind, I want to say getting the deal done. That you get right off the bat. Oh. Whereas with us, we said, okay, well, if we've got we want to be flexible. And a lot of the reasons deals weren't getting done with search funds was, they couldn't make that 10, 10, 10 work, right? So we heard of a couple of scenarios where there were people invested in the fund that would see an investment memo and would love it. And then the searcher would say, we just can't make this work, which is fair. I mean, they're committing themselves to the business for 5 years, and they need to make an income as well, and they need to make a return on the thing. And, typically they've left lucrative careers. So if you look at something that's going to pay you $1 million over 5 years and you left $500,000 a year, the returns aren't quite there. So you need something that kind of offsets that. And what kind of was one of the light bulbs for us was we spoke to a couple guys that were invested in these search funds in the search capital piece that had seen the investment memo. The searcher said, we can't do it, it's not big enough, or we can't do it, the returns just don't make sense for us. And the investor went out and said, okay, well, I'm going to go ahead and do this on my own then, right? When I saw that, I said, okay, the person providing the capital still wants to do it, but you can't make it work. I said, okay, well, there has to be an intersection there where the person providing the capital is willing to give you better terms to do the deal until that deal doesn't become, lucrative enough for the investor and or the searcher. And the way we got around it, which isn't that designed, but it's pretty simple, was, well, let's go ahead and not take search capital, and we'll figure out what economics we need to make work on every deal. And if we're too aggressive, we'll let the market decide, and we won't be able to sell it. And if we're not aggressive enough, it'll be really easy to raise, and that's okay. It's our first deal. But that was the main reason that we did that, was we want to be able to look at different types of deals, smaller deals, right? On a bigger deal, you can go less on the economic side because it makes sense. But smaller deals, you can find some fantastic businesses that are less competitive to go after, that are really great, that can actually use our help in professionalizing and really adding some of that fuel to the fire, versus that $7 million EBITDA business where we're competing with your more traditional Torquests and not quite Birch Hill, but Imperial Capital, etc. Where candidly, if we win that auction, we might have done something wrong. They've got more resources than us. The smaller side, it's more relationship based. It's less institutionalized, less professionalized business, that they care about what happens to their baby, because oftentimes these businesses preclude their children. And it's just, it was an interesting space to play. We wanted the ability to be flexible. Do we look at high growth companies or low growth companies? And this gives us the opportunity to say, okay, well, with a low growth company that we're going to hold longer, maybe we change our economic model so it's more, we can find the investors who want to do this deal, because there's an investor who's looking for yield, as you know. There's also investors that want, cap growth, right? So we wanted to be able to do both and be flexible and be nimble with the market and not really put ourselves in a box. And self-financing certainly helped do that.
Yeah, I think, in hindsight, I think that is the very, in one sense, kind of being like the good steward of capital. Like, I think even in the public equity side, there are managers like Munish Bhai and like Buffett also is a very big advocate of this, of not taking management fees and only being paid on performance, and being the one to be, you risk your own capital and you put your neck out there and you really eat your own cooking that
right.
way. But yeah, I think it could, even like I'm trying to imagine it must be probably like daunting to know that, yeah, like if this deal fails and it's on us, and like all the pressure from that.
Yeah, it is, and you know, I certainly don't want to classify the guys who are doing the guys and girls who are doing the search funds as, you know, being inherently greedy, because that isn't the case.
Right.
I think it's, you know, we were fortunate enough to, as I mentioned, be a little grayer, a little more beaten up, where we had, you know, we had the capital to be able to risk to do it. Not to mention, you know, at the time we're both single, no children, not married, you know, not a ton of overhead, right? Like we live pretty lean. So we had the good fortune of doing that. You know, if you've got 2 kids and, you know, you're married, or whether you're not married, who knows, but you own a house and you've got a bunch of overhead, you look at that and say, okay, well, I'm not going to ask for $250,000 a year, but, you know, 80 grand a year, let me just keep the lights on. Right. And so it's not inherent greed. It's just we were fortunate enough to say, hey, we've got interesting life circumstances here that we're both able to take a risk and do it.
Yeah, and I think that's like your situation and the kind of lifestyle you lead. Those can actually be competitive advantages that if the people, you know, want to really utilize it, you can actually use it to your strength that other people might not be able to. And so then, you know, you decide to say, okay, we're going to use our own capital. But how did you go about getting the backers, like getting the people, convincing the people to eventually fund this acquisition? Like, how does that work? Because, you know, I'm trying to think, like, you know, what would someone say if an MBA kid who just graduated with some banking experience came up to them and said, hey, I want to do a search fund. Can you back me up?
Right. Yeah, no, it's you know, again, the Stanford primer has some pretty good some pretty good pointers on that. There's another book by HBR that is Think Big, Buy Small. That's great and is a nice step by step on here's how to do it. I think, you know, Laith and I were fortunate in that, you know, we had the opportunity to work with some high net worth individuals over our careers, as well as have, you know, some have kind of fallen into our networks as friends, professionally, etc. That we really didn't raise any institutional money. Like there was never a point where we said, "Hey, here's who we are," until later on, where, you know, we start to get a little more strategic around, "Hey, it would be really great to bring in an investor from this geography who has experience in these businesses." Then there was a, "Hey, here's who we are." But for the initial support, it was really, you know, folks that we had worked with and former mentors that we said, "Hey, this is what we're looking to do." And they said, you know, "We're 100% in." And that one of the benefits of that is they know how we work. They know what we're good at. They know what we're not good at. But there wasn't much of like, you know, my name is Sam and that piece. Whereas I know a lot of the traditional searchers do have to go that path, and that's okay too, right? There's a ton of capital out there looking to fund, you know, smart young people to do this, or smart people in general. It doesn't need to be young, but smart people who are willing to do this. And we haven't gotten into this piece, but the reason is, you know, if you look at the valuation of public markets, right, it's tough to deploy capital in it. You know, it's tough to deploy capital in this market. It is. And if you look at the cost of capital and how cheap money is right now and the amount of money that's out there chasing everything, it's tough. If you talk to anyone who works at a larger private equity fund, they'll say deploying capital into, you know, the $20 million plus EBITDA companies is now tough. You're, you know, a 20% IRR net of fees for a PE fund these days is not easy to come by. I think most guys are bidding down to, you know, high teens, and high teens is probably good in certain circumstances. I mean, I remember there was a deal that I looked at, and this is 3 or 4 years ago, when I was still in banking, that, you know, there was a very large asset with 2 parties involved, and I won't mention either the asset or the parties, but, you know, $1 billion plus check, and it got bid down to, you know, low teens, like 12-13%. So not even teens in this certain case, but 12-13% IRR, because they need to deploy. They do need to deploy. Wow. Because you have a lot of capital sitting there. So it's getting tougher to deploy large amounts of capital, and getting a return is tougher. So if you're an investor and you say, okay, I still would like a 20+% yield, in certain cases the smaller deals are higher, call it 25-30% plus yield after fees, I just don't have the time to run around and chase these things on my own, right? And it's tough to have the infrastructure of a private equity fund where you've got partners and you've got VPs and principals and associates and analysts running around doing that, writing $10-20 million checks in terms of total value. In terms of equity, half of that, right? 5 to 10. You look at that, you're like, okay, well, I can't generate a management fee to cover the infrastructure costs of doing that. So what they need to do is they have to find some younger folks that is a lot of money for the younger folks who say, okay, well, I'll operate really lean, I'll do it myself, and we'll take your capital. So we'll take your capital and invest in there you want. And there's a lot of demand from the investor side to say, hey, we want exposure to these deals. We're getting told by investors that, hey, I have friends that would like to get into the next deal you guys do. So it's not for lack of capital. It's really, picking your spots and finding the opportunities you want to chase down, because there are a lot of opportunities. There's also a lot of people chasing them. But as I mentioned earlier, the one really nice thing about our segment of the market is there still very much is that personal touch, which is, the feel, the relationship. Because there is an emotional attachment to the business that in a larger company you don't necessarily have. Where if your fund mandate is to be highest price at all times, and this isn't, I'm not spitting wisdom here, I think everyone knows this, but if you're winning because you're highest bid constantly, either you're that much smarter than everyone else that you can underwrite higher risk and underwrite to a different return, or you're just kind of paying for access. And I think in our segment of the market, we don't have to do that. We can go, we don't need to be top bidder. We can build a relationship and really develop that rapport with the owner where they trust the fact that the company's going to be in very good hands, and we're not going to tear it apart. We're going to help it grow, and that's what we're really, really interested in. So that's the interesting segment of our market, and that's why, going full circle, why approaching investors is less daunting than one would think. I mean, I remember our first calls, I had 10 people that I knew I wanted to go out to, I had good relationships with. And I said, you know what, if I can get, this is kind of proof of concept time. I said, if I can get 4 or 5 of them to say they're interested, it's great. And it was over the course of like 3 days, 10 phone calls / meetings, a lot of coffee over those days. And I had 10 people said, yeah, absolutely. I mean, granted, who's going to say no to a free option? But they were supportive, and they've all proven to be supportive even through the first acquisition, which was great, where they had to put their money where their mouth was. But it worked out, and I don't think that's a special circumstance because we're extraordinary people. I think it's a function of the market, and I think it's back to that concept of signaling. It's a function of here's what we've done in the past, which means we're not absolute zeros, right? We bring something to the table, and we have some chops, and at the very least we can build good relationships and find good businesses, and you have the option to say, yes, I'd like to invest, here's how much, or no, this one isn't for me.
No, yeah, definitely. And so now you have your investors, and you alluded to how you pick your spots, your area of competence or your circle of competence, and you decide to look in different areas. And so you've segmented down to, okay, size, we're going to go down to smaller companies, and you decided to not go with the search fund model where you just completely buy something up, but rather you buy something up, but you are not acquiring just one company, but the idea is to acquire multiple companies. And sometimes it might not even be that you're losing a CEO in terms of like you're buying a company and the founder's running away. Sometimes it could just be the founder still stays on, but they could actually realize the value. And so how did that business model develop, and how did the thought process work for that?
Yeah, I think when we first started, we were willing to be flexible. Back to that concept of flexibility. We were willing to be flexible and nimble. And what we said was, our job is to generate a return for the people who back us. That's our job. Hard stop. That doesn't mean that, we have to write a $3 million check or a $20 million check. It just means we need to generate a return, right? And find a deal that we can sell. So when we first started, we were really flexible around, do we step into a management role, right? And we said, we'll look at companies that we have to do that. There's 2 of us. That means that we can do 2 deals reasonably until we get the next level of infrastructure in place and then separate ourselves out. So the idea was always to do more than one. It just so happened, we just made an investment in a fantastic, Toronto-based business here called New Sales. And management stayed on, and it was a really great deal, really cohesive partnership. Really energetic management team that wanted an investment from a strategic. I mean, we're not a strategic group, but from a party that brings some value aside from just money, because that's not really what they were looking for. And it worked out really, really well. So, I mean, in that scenario where we've got a management team that's incredibly competent and can take the business to the next level, but wanted to complement their skill set to say, hey, would love some attention in these areas where we think we can create some value. We looked and said, this is an ideal scenario. I mean, they're literally 4 blocks from where we're sitting right now doing it, and that's it kind of back to that concept of it kind of came together. I mean, it really did come together in this scenario where it was the right location, right age management team, right scenario where what they were looking for we could provide, built a great relationship, but also allowed us to say, okay, great, we're gonna help grow this business, and we're gonna grow like crazy. And management's already doing a fantastic job of that, and I mean, we're trying to, we're inserting ourselves where it makes sense, but it also allows us to sooner, or more quickly relieve ourselves of, okay, we're not just going to look at this asset, we're going to actually go out and look to do another one, and it worked out well. We were flexible, and we still are flexible, and I think that helped us. Having said that, for anyone who's listening to this, and I know you have a lot of subscribers, so I shouldn't say anyone, but anyone who's still on listening to me drone on, it's interesting that you'll find a lot of opportunities. You'll find a lot of opportunities to deploy capital. You'll find a lot of opportunities to get involved in management. I think picking your spots is really, really important, and making sure that your first deal makes a ton of sense is really important. And there are a lot of businesses out there, and really great businesses that capital can be deployed into. And candidly, there's a lot of room in the market, right? This isn't a predatory market. This is actually a segment of the market where we're grabbing a coffee or a beer with a bunch of other groups that are doing the same thing as us, because there is enough room. We're helpful. We throw deals their way if it doesn't make sense for us for a number of reasons, and they do the same. So it's a really friendly environment, and one that isn't predatory, and there's a ton of opportunities.
Mm-hmm. And now as we go into more, I guess, just like how before you went into investment banking, you had a thought of this is probably what they do, and then when you went into it, you realized this is what you actually end up doing. So what do your friends think you do with Golden Spruce, and what do you actually do?
Well, I'll go higher level on this one, because it's a funny story. So when I first, I'm the product of Italian immigrants, right? My parents moved to Canada, but they were both fairly young, but there's a certain mentality there, right? There's a certain mentality of get a job, security, and that's what you do. And I remember telling my mother, hey mom, this is what I'm looking to do. And she said, it's okay, hang on, let me get this straight. You're going to run around and talk to business owners. Yeah, follow. Okay, and then you're going to tell them you're going to buy their company. Yeah, and you're gonna determine what to pay for that company. I was like, yes. Okay, they're going to agree to sell to you. Yes. You're then going to go out and raise millions of dollars to buy this company. Yeah. Sam, I think you're nuts, right? Like, I mean, if you're just like, I think it was the first time I saw in my mom's eyes, he's lost it. He's completely lost it. And my uncle, who's a chef, I had a very similar conversation where you just see this like real concern enter their eyes. We're like, I'm not talking to someone who's mentally sound. But it's just a funny story there. But what we do is really, I like to think we build, at least in the initial stages, build relationships first and foremost. I mean, we've walked away from deals that the price was right, the returns looked good, just didn't feel good about the potential partners. And maybe for someone else, they were a great fit, but for us, it just didn't feel right. A lot of this is, not to go Soros, like I wake up with an upset stomach, and as a result, I don't do the deal. But a lot of this is, how do I feel about working with this person? Because if you can't get a good partnership in good times, there's going to be bad times, and it's only going to get way worse, right? So, a lot of what we do is relationship building. A lot of what we do, it's actually really exciting, because what we really get to do is we get to be students of industries every day, right? Where we get to talk to an expert in the field every time we talk to a new business. And, you take that little learning and you apply it to the next one, you get smarter on the space and smarter. And we get to talk, from the fashion industry to the most random thing we've been approached to do is finance a movie. By the way, we didn't do either of those things, but that's really interesting. Like, we know how both those things work. So I'd say we're really building relationships for students of industry, and slowly we're becoming, subject matter experts in certain spaces. And then the part that would probably surprise the people the most is post-close. Okay, now what do you do, right? How do you help the management team here? How do you help realize value in picking your spots? But it's a lot more sensitive. It's a lot more, and again, this is how I approach it. I've always been a little more relationship driven, but there's a lot of soft touch to it, because you have a management team that's competent. They built it, right? So you can't fly in and say, hey, I know how to do this and I know how to fix it, get out of the way. And I honestly think people who do that probably end up destroying more value than creating value. We also don't invest in distressed companies. We invest in companies that are doing very, very well. And it's almost how do you slowly help, right, or softly help without getting in the way of the captain. Let him steer the ship. So that's been the part that's probably been the most surprising. Granted, it's the newest for us, but figuring out that dynamic and how do we help? Where can we help? That's the part that I shouldn't say we're figuring it out in real time. We're doing in real time, right? But I'd say that's the thing that people would be most surprised about. Is it's not just you don't get the deal done and then run and go do your next one, right? It's you've got to really understand the company. It's not as simple as saying, okay, buy, here's my limit, boom, got it done, and now I'm going to sell when it does 20%. Like, it's got to do 20%. And we have responsibility to a lot of folks to make sure it does 20%, or in this case, a hell of a lot more than 20%. But, I'd say that's it. But yeah, no, every time and someone asks me what I do, I always think about my mom asking me that question, just not understanding. It was just hilarious.
And I think, like, people would only see the end product, right? They just see that, oh, you did a deal. Nice. Good on you. Now You're probably looking at the next deal. But like you said, it's been about 2 years of running Golden Spruce, and the deal that you said it recently kind of closed. Mm-hmm. And so you've had that kind of at least a 1.5 year period of just talking to companies nonstop. And how is that kind of like typical day like, if you had to run through like a Monday, looking at companies and all that?
Yeah, I've always hated when, I remember an MBA and I asked people, or someone would ask, what's your typical day to a banker consultant? They're like, well, there is no typical day. And now I'm about to say it. So I won't say it that way. What I'll say is every day is different.
Right.
We have interns this summer. We ran an internship program, which was fantastic. We had, 5 really quality people in the office. 4 really quality people in the office. In addition to Laith and myself. And that was a bit different. It was a little more structured, but really we're on the phone most days with entrepreneurs. We do a lot of outreach. We reach out to, we'll pick an industry we really like for a number of reasons. We'll then sit down with one of our interns and we'll say, okay, this is the industry we're going to focus on. Go out and find me, the top 50 in your mind in this space, in these geographies, and then let's sit down and go through them and understand why it is you like them. So they get to learn how we think about what we like in the company. And we also get, labor that's helping us kind of build out our CRM, right? So that's a big part of every day with the outreach, the outbound, to build that, call it proprietary channel, that it doesn't come through boutique investment banks or the accountancies. And then we're having conversations with folks. Now it's different, right? Now it's different where I'd say we're probably, the easy ratio, because it's used all the time, is 80-20. The 80-20 is flipped. Mm-hmm. So now 80% of the time we're dedicated solely to, ensuring that this asset continues to do really, really well, and we're supporting. But there's going to be a period of time where that flips, because We've got a really competent management team. We've put systems in place, and that's humming and growing, creating value for our investors. And now we're going to be spending, not now, but in the future, we'll flip that. It'll be 20% of our time, and 80% will be back to talking to entrepreneurs and doing all that good stuff. But the reality is, you need a very full pipe, and these things do take a lot of time, right? That's one of the things I wouldn't have appreciated. And back to your question around, what wouldn't your friends or someone really understand? It's not like buying a house, right? It's not like saying, okay, this thing's for sale. You're not on Amazon saying click to buy, right? One click to buy and you're done. It's an incredibly detailed process. It's iterative. You have, irrational people on both sides, right? Because we're human beings and we're naturally irrational. You have emotion running through that. You have cold feet. You've got a number of things that come up, and it's coming up every day, that they do take a long time. So as a result, you've got to build out a pipeline, and that pipeline needs to be robust. And you keep the pipeline going even through acquisition. So I'd say right now that 20% is really being spent on what were the active businesses and owners, who are we talking to, and let's keep talking to them, and let's keep working with them. Because if we were to sign an LOI tomorrow, LOI being a letter of intent to purchase, non-binding, I'd be surprised if that deal. I'd be shocked if it were to happen in under 4 months. But if it were to happen in under 6 months, that'd be quick, right? Wow. And that's with two parties that agree to get together. If you think about the proprietary channel, this is back in my days in Dental Corp, where I really kind of thought about this. I said, okay, I'm reaching out to someone who's not thought about selling. So they first need to be willing to entertain the conversation around it. Second, they need to be willing to wrap their head around selling. Third, they need to determine that we're the right party to sell to. And fourth, they need to determine that we've offered the right price. And there's a lot of things that go into that. So when you build out your proprietary channel, it takes a long time, but it's very valuable, because that's where you can create real value and create long-term partnerships. And you're not running through a process, so it doesn't come down to highest dollar. Ideally, you don't want that to be the case, but we're all economic animals. So I think that 20% is going to be focused on managing those relationships that we currently have, versus going out there and pounding down new doors, at least for the next few months, until we feel very, very confident that the portfolio company is performing well. I mean, we've staked our careers on this, right, and our reputation. And because and I feel like we do the same thing if we went institutional, but we brought a lot of our, mentors and our networks money to this deal. And as a result, this isn't if it goes bad, we just walk away. No, this is we care about it, because we see these people regularly, not just to talk about the business, but even outside of that. So, there's a great deal of care here, and back to choosing our spots and picking our spots. That's why, we took as long as we did to get to where we are. We said no a hell of a lot more than we said yes. Wow.
And for you personally, though, as you're shifting now, your 80-20 has shifted. Which side do you enjoy more? Which side puts you more into the flow state?
Ooh, that's a really good question. I'm still in the honeymoon phase, right? Still relatively early in terms of that, in terms of the creating strategic value in the business. I find it really interesting. I love learning, right? And I love, if I could get paid to be a student the way I want to get paid, I'd probably be a student, right? I really enjoy learning. And I think right now I'm in a heavy learning phase of this, where we're in the business, we're meeting all the managers and taking them out for coffee and learning about their roles and trying to figure out ways that we can make their lives easier to accelerate, some of the initiatives that they have. That's really, really interesting. It's been fun. It's been nice to switch gears. So I think that certainly puts me in a flow state. But when I'm most in my flow state, I'd say is certainly when I'm building relationships with people, right? But that's not limited, or I shouldn't say that's not mutually exclusive to deal sourcing versus post deal execution. Now actually implementing about creating value. I really love interacting with people, and I think that's one of the areas. I was giving a talk at U of T last week, and I think that's one of the areas that often gets downplayed in our industry, is that it really is a people-based business. And the moment you make it solely about numbers, I think you've gone astray, and you've started to play a dangerous game with financial engineering. I do think that this is a people-based business. It's based on relationships first and foremost, and then you see if you can make the economics work, right? But not surprising, if you've got a great relationship, the chances of making the economics work are a hell of a lot higher than if you're solely using the economics to lead the discussion, right? So I think that the people aspect, the soft aspect of this, the relationship aspect, is the part I enjoy the most, and I think the part that often doesn't get talked about or thought about as much.
No, yeah, I think what you're saying is like it really kind of hits the nail on the head in terms of how generally business is a people-to-people thing. And I think though what I've found is in the investing world is like the higher you go up in the companies you buy, it tends to get more focused on the economics and less on the relationships. And I think that's where the inefficiency comes in, where you just can't run an algorithm through. You just can't decode the business in that sense. Like even in the public markets, you look at a micro cap compared to a large cap, way more inefficiency there, and you talk to management, it actually matters. And I can only imagine that it's even more severe, the magnitude is just greater in the private sphere.
Yeah, no, it's definitely the case. I think, if you think about public markets, certainly as you go large cap, look at the number of shareholders, right?
Yeah.
So if you can break the number of, or not break, but increase the number of irrational people at the table that have smaller pieces, I think it actually decreases the emotional nature of the decision to sell or buy. The moment you start to concentrate that, which you probably find more and more in small caps, certainly in private, where the business is in 2 or 3 people's hands, and in small cap, you're probably in, I won't even throw out a number, but a hell of a lot less than where you're in a large cap. It does become more driven by the personality of the person who owns it versus the other side, which is, okay, you've got a board who's now making a decision on behalf of the shareholders, unless you've got a very large shareholder who can ultimately make a recommendation and, approve purchase, whatever. With private, you don't have that. The board, you've got the jury and the executioners right in front of you at the table, and they can determine if they want to do it. And sometimes, we are human beings. You have a conversation with someone who had a fight with their spouse that day, right? And they don't like you that day, or you remind them of someone they don't like. There's those components which are true for any business. It's just our business, the power tends to be concentrated far more to that person, which is just it makes it interesting. It really does make every day quite different. And one of the really unique things with what we get to do is because I have a partner in this, we're very different people. And there are some of the people we talk to are more like me, and some of the people we talk to are more like him. And I find that really interesting to manage that dynamic as well. But I find because we're such, we really are on, the way we, he relates to consult, we're a reform consultant. And we've talked about the concept of, Venn diagrams. Our Venn diagrams just touch, right? There's not a massive amount of overlap, which actually works out well, and I think it's the way you want to do it. But that's both from a skill set perspective, and I think they're slowly starting to merge a little bit, but we still have enough separation. But from a personality perspective, I think they touch enough that we have commonality, but different enough where we can actually address a lot of the market and appeal to a lot of different people. And I think it works out really well that way, and it certainly makes every day really interesting.
Yeah, and I think even in general, I forget the essays, but there's another like HBR essay on structuring teams properly, and it's like, you practically want all the right people on the bus who are of different skill sets and cover your blind spots, your weaknesses, and everything. And you actually that's what true diversity is. It's not really racial or gender specific. It's actually more skill and personality based.
Yeah,
you actually want diversity.
Exactly, and I think we've benefited from it in, again, very small sample size, but I think we've benefited from it. It comes with its challenges too, because you do think about things very, very differently, right? And this is a partnership-based business. But I think net, we're far ahead for being partners in this, because, I'll think one way about a business and he's like, well, you forgot about this whole piece, right? And very valid point, or vice versa. And I think having that natural check and balance, whereas if we thought the same way, we both are blind in the same area, right? The blind spot reference that you just made, I think is so true. And it just, again, meeting different people, working with different people, that really is the exciting part of the job for me. And, he might have a different view on what's exciting for him, but although I think, I know he really enjoys that component as well.
Yeah, no. And as we kind of wrap up closer to the final legs of the interview, what was like the largest obstacle that you and Leif faced in operating Golden Spruce Capital? Like you looked at it and you go, man, that piece required a lot of perseverance, like a lot of grit to get through.
Well, honestly, every deal takes so long, right? So, the biggest piece of perseverance was really around, we had a deal go sideways a year ago. Actually, a little over a year ago, about 14 months ago. And we'd spent a ton of time on this asset. And we were both really excited to do it. It would have been a very fast close from when we first started to get it done, which would have been really exciting. Loved the business, great business, still is to this day, but some things changed at the final minute and we couldn't do the deal. And, I remember that next day after that deal was done, right, where, you're so convinced you're going to do it and you're like, we're going to get over this hill. The next day, it was, end of July, early August. And I was like, okay, wow, we don't have any calls with lawyers. We don't have any calls with accountants. We don't have diligence to do in this asset anymore. It's done. Like, it's gone. What do we do now? And it's like, oh yeah, that's right. We have to start reaching out again and say, hey, remember us, we're Golden Spruce Capital. We're still here looking to buy something. And trying to do that in August is incredibly challenging because no one wants to talk in August, right? Like entrepreneurs, that's like the month of vacation for everyone, but certainly in that world, they're not talking to new people then. So we had a month that was relatively dry, and we're both very biased to action, and it's tough to stand still after you've had what at the time felt like a massive failure, to stand still and say there's not much we can do right now. Aside from building out the CRM and building out new industries and thinking about that. So I'd say that was really challenging, but overall the industry requires a ton of perseverance because you get a lot of figurative doors slammed in your face constantly, saying I don't want to talk. Who told you to call me? No one told us to call you, right? Like we like the industry and we thought we'd reach out. But we get a lot of doors slammed on your face, and that's in your face. Sorry, and that takes time to build some tolerance and some tough skin too. I think I got really used to that at my time at Dental Corp, kind of flying around trying to do deals with dentists, and as a result, it doesn't really impact me that much. It's you can't love dealing with humans if you can't handle the negative side of that either. But I'd say that in general is the tough part. It takes a long time, right? And I was talking to a friend of mine who's in the industry, and I said, yeah, we're getting close on this one. He's like, and I was like, but every day something new comes up. And he said, he's done a couple deals at this point. He said, Sam, I sometimes sit back and look at the deals we did and say it was an absolute miracle this thing got done. Like I can't believe it actually got across the line. And it does take a lot of things fall in the right direction, right? If it falls the other way, deal's dead. But if it goes that way, you're good to go. And there's, you're certainly as you approach deal close, that starts to happen increasingly every day. So I think the perseverance piece is probably starting with relatively low blood pressure because it will rise over the process. But I think, being willing to kind of pick yourself up from your bootstraps and say, okay, time to get up and now get back on the phone and start talking to more entrepreneurs and drive out to Mississauga and Brampton and Barrie and, Whitby and, all of these smaller towns because, it's very rare you find a business that's downtown Toronto that's, in the sphere of what we look at and start all over again, right? And you've got to put on a brave face for a long time to keep doing that. And I think that's the challenge. And that's the really, to say to persevere, you need to persevere through perseverance is effectively really what it is. This whole job is, it's long lead times, few deals, and you don't hear no always at the same time, right? You can hear a lot of yeses, Then one day they woke up on the wrong side of the bed and the deal's gone. It doesn't mean it's gone forever, but you've got to be willing to take that, manage it, and move on with your life and keep your business going.
Mm-hmm. And so, you've made a prediction back when you were in your MBA saying that, okay, in 10 years, I'm probably going to be a managing partner at a private equity firm.
Right. Which is actually, that's verifiable on Google if you search it. Yeah.
So you've made that forecast, but if you were to kind of look back at your 20-year-old self, your 20-year-old Sam, probably in the third year university, were to look at where you are right now, what do you think the emotional reaction would be?
I think pretty damn impressed. And it's funny you ask that question. I mean, I've never thought of it that way. How would I look at myself at 20? I'll tell you how, I think pretty impressed, but the more tangible thing for me is 2 years ago, right, when we started Golden Spruce Capital, if I were to look at what we've managed to do to date, which is just one deal, right? Just one deal, and it takes a long time again, but just one deal, I'd be giving myself a pat on the back even 2 years ago, right? It's a real challenge, and it's also, we have to remind ourselves every once in a while. I find that people in many industries, but in our industry in particular, and those are the people I interact with the most, have a hard time kind of celebrating small wins or even big wins because we're so driven and we're so, okay, great, we did this, but now we've got to go to the next thing. I find it's important to savor some of these moments, right? Like, I'll remember the day that we signed and, we cheers a glass of champagne. That was fun, right? But, you got to keep driving forward, but still remember that, hey, we've come a long way. We've done a lot. We're certainly not done. We have a lot more work to do and a lot more investments to make and a lot more money to make for our investors. But no, it's nice to see your thesis come true. It's a nice pat on the back moment. But, as one of our investors said when we let him know we got the deal done, we said, just want to let you know we closed and, congratulations on making the investment. And he said, great work, guys. He said, that's great, guys. Now it's time to get to work. Right. And it was like, oh, wow. Yeah, you're right. That is the exact way to think about it. So definitely would have, looking back projecting myself forward, my 20-year-old self probably would have said, told you so, given that I wrote that in in Toronto Life. But no, I think pretty proud and certainly not the path I thought I'd take to get to here. But, that's part of it, right? That's part of what makes it fun.
Yeah. And if you could give advice to that 20-year-old self, or the advice you wish you had gotten at that age, what do you think you would have wanted? It's funny. I remember not getting into investment banking, and that was just devastating, right? Like, it was just like the world was going to end. I was like, I'm never going to be the person I want to be as a result of that. And you think that, when you're 20, you haven't had, or I hadn't had that many failures in life, and as a result, probably wasn't as resilient as I needed to be at the time. And I think the advice I would give myself is, hey, it all is going to work out. And it sounds like a lazy cop out, but if it's meant to be, it'll be. All you can apply is energy towards it, right? Apply effort. But if it doesn't work, your life will be fine. You'll be okay, and you'll find something rewarding. And something you can be passionate about, because I find that at least for myself, investment banking was really the thing I was geared towards, and that was what was going to make me happy, and that's what I was passionate about. It's not what I was passionate about. What I was passionate about was working with really smart people, and if you start to broaden your definition of what it is you want to do, instead of being so narrowly focused, you can start to say, okay, well, what else can I do to work with really smart people? And I get to work with really smart people every day now. So I'd say that is a lot of advice for my 20. Apparently I had more advice for my 20-year-old self than I thought. But I'd say that's it. Just don't define success so narrowly, and things tend to work out. No, I think that's actually great advice. I think I went on the journey myself too, in terms of I always thought I was super passionate about value investing and public equity investing, and so I went to work at a hedge fund. But it was just distilling down to like why investing, and then it became, because I really loved powerlifting, then why powerlifting, and it just ultimately just became that I just love learning. I just love optimizing the human system.
Right.
And it was just, okay, then what can I do that actually
Exactly,
has that?
yeah.
And it was, there's a lot of different things too. And so that just became, okay, then let's just combine my values, my strength, and let's just find something else about
Right.
it. And yeah, I think that distilling down to the first principles of what is it you're passionate about is actually a valuable thing to do and reflect on.
Right.
Yeah, no, that's great advice, definitely. And yeah, Sam, thanks so much for the time you've given and coming on the podcast. Like, I really enjoyed it. And
no, thanks for having me. I was surprised to get the reach out. I remember I got the email from Charles, and I was like, well, I've always been told I had a face for radio, but I'm not sure what value my story is going to bring. But thanks for having me. It was a lot of fun, and hopefully some of your listeners learned something. Learn something new, or maybe get an idea for where their next internship will be.
Yeah, definitely. For people who are looking for an internship at a small private equity shop, definitely reach out to Golden Spruce Capital. And yeah, Sam, thanks so much for coming on, and thanks also for sticking around for all the battery issues I had. I really appreciate that.
No problem. Thanks.
All right, thank you for listening to the podcast. I hope the story was inspiring to you. Hopefully it also helped you expand your perspectives. Hopefully it also made you question the default path that you might have been going on, or the default beliefs you might have had. And maybe now it'll make you even think about doing something about it, doing something different maybe, challenging yourself, being courageous. Who knows? But regardless, I'm really happy that you took some time out of your day to listen to this fantastic story with my guest. And if you would like to somehow, in some way, contribute and help support the podcast, and maybe even just be part of the community that I'm trying to build with the greater OMD Ventures platform, really think about being a stakeholder in the platform. And the quick way to do that is to go to my website, oldmandan.com, and go to the stakeholders page. I believe it's oldmandan.com/stakeholder. And the link is also down below. And that's how you can figure out how you can subscribe, follow to get more updates on the free content. But at the same time, also donate. And donate by actually just buying me a coffee. That's just how I put it. And you can buy me a coffee a month, coffee a week, or coffee every day of the year. And think about it as the way that, if you wanted to chat with me, you might just bring me out for coffee and buy me a coffee. Or if you wanted to bring one of my guests out to chat, you might buy them a coffee. So just think of it as I'm the service that's doing that for you, so you can just pay me in coffees. Don't worry, everything will still be free. It would just really help if you would like to show your support this way, so that I can use the coffee money to buy myself actual coffees, and also to buy my guests actual coffees, and use the leftover money to actually grow the platform, as well as even keep it operationally alive as well, because all this isn't really free, and it does take a lot of time to build it as well as operate it, and hopefully grow it further. So your support would be amazing if you would like to contribute. And so yeah, just check out the website, go to the stakeholders page, and read the different kind of benefits you might even get as a stakeholder. All right, thank you.